All right, so thank you guys for joining this webinar today, Tax Tips for Realtors. Basically, the purpose of this webinar is really to give you some information on just some tips and tricks when it comes to taxes. We'll be going through a lot, so we have a lot of information here. If you need more information, you can feel free to reach out to me after the webinar. Number is 773-679-7198. You can also email me at jb@ladutaxservices.com. I'll share my contact information and everything at the end of the slide. And for those that are just joining, if you have a contribution, please feel free to cut me off or feel free to put your question or comments in the chat box. We have quite a few people joining us today, and we have a lot of information to cover. If you're not talking, we just ask that you mute yourself, just to avoid any background noise or anything like that. Hopefully you guys can hear me okay. Hopefully you guys can see my screen. But let's get right into the presentation. So just a quick agenda today. We'll be going through an introduction of who I am and what it is that I do. We'll be talking about the proper way to incorporate yourself as a realtor. And one thing to note, although this is tailored to realtors, it can be tailored to really any business owner. So this is geared towards realtors, but it can be really tailored towards any business owner. We'll be talking about some taxes, some loopholes, strategies, things of that nature. And then we'll be going over how to properly maintain your books. Very important to maintain your books and records. And then throughout the workshop or presentation, you can ask any questions you want at any time. But we will have about 10 minutes or so at the end for Q&A. So at about between 7:45 to 7:50 CST or Central Time, I'll leave it open for any questions. And please, if you guys can't hear me, if there's any distractions, anything that's not going right, just put it in the chat box, cut me off so that I can make sure I fix it, because this is very important information, especially around this time of the year as we're heading into the 2020 year. So a brief introduction of who I am. The speaker today is Jeff. I'm a licensed certified public accountant. I'm a U of I grad, so I went to the University of Illinois at Urbana-Champaign, got a bachelor's and a master's degree in accountancy. I'm a paralegal entrepreneur as well as a wealth multiplier. Simply, I own multiple businesses. And basically, what I do within those businesses is I help people multiply their wealth in infinite ways. My primary company is Badu Enterprises LLC, which is the parent company. We own and operate about 11 companies in the enterprise. Our marquee company is Badu Tax Services, which is who's the sponsor of today's webinar, by the way. But it's a tax firm that specializes in tax preparation, tax planning, and tax representation for individuals and businesses across all 50 states in the U.S., and we also have clients in about 8 different countries now. We're always expanding, so we're always looking for more people to become a part of our what we have going on. We do have a lot of clients, but we really cater towards our clients. When it comes to customer service, we truly pride ourselves in offering the best possible customer service, because truly, when you're running a business, that's what it's all about. It's all about making sure your customers are happy and making sure that you're adding infinite amount of value to your customers. So that's my tax firm. We also do bookkeeping, bookkeeping, CFO services, and other services of that nature. So anything accounting, anything finance related, we can essentially help you out with. And then I'm also a real estate investor. So Badu Investments LLC is primarily a real estate investment company that invests in multifamily units on the south side of Chicago primarily. So we do anywhere from 3 to about 20 units now. So we specialize in those types of buildings. Basically, we buy them, whether they're fixed up or not. If we need to fix them up, we'll fix them, and we put tenants in them. And we also do have private real estate funds that we open to people from time to time, buy more bigger units. And there's a lot of other companies, and we'll go through that today because that's not the main purpose of today. But I will say that I'm very passionate about financial literacy. which is why my firm does a lot of webinars. We do a lot of presentations, workshops, things of that nature. So we truly like to help people when it comes to their finances, financial literacy. I mean, I do a lot of workshops. I'm a Money Smart Group partner, so I help distribute material to the community as far as financial literacy. So it's definitely something I take pride in, and my purpose in life is to inspire and support the super hungry to take hold of infinite resources in order to create an abundant lifestyle. For those that don't know what that means, I'll actually be displaying that in a book. So I'm actually writing my third book, which is almost done and will be released next year, which goes into my purpose very in depth, 12 steps about the purpose and how to create an abundant lifestyle that we all truly desire and truly deserve. So let's get into the first part. Before anybody starts a business, before you go out there and sell your first piece of real estate, or you go out there and you sell even lemonade, whatever it is, you need to have some sort of entity in place. It doesn't matter if you're working for a brokerage. It doesn't matter if you're a managing broker. It simply means, basically, we want to make sure that we're running a business or we're doing business in the best possible way. The only way to do business in the best possible way is to make sure that we are incorporated. That's the very first step when you're running a business, really. Assuming you have your business plan and you have all that in place, when you're actually running or you're implementing your business plan, the first step is to get your business registered in the form of an entity. Now, there are three main types of entities. One thing to note is an S corporation is not actually an entity. It's just a tax structure. I'll get to that in a second. Basically, there's two main types. There's LLC, limited liability company, and then there's a C corporation. And let me just tell you what the difference between the two are. With an LLC, essentially, it protects your personal assets, so you get the liability protection. Basically, if somebody were to sue you, they cannot get a hold of your personal assets. So essentially, if you, let's say you go out and you're selling real estate, you're selling real estate on behalf of clients, or you're buying real estate for clients, and let's just say somebody sued you for whatever reason, maybe because they thought you didn't find them the best property. Well, if they sued you, they would have to sue your LLC, first of all, and your LLC has personal liability protection, meaning that they can only take what's in the LLC. They cannot take your personal assets. So that's very important because it allows you to protect yourself. So with this liability protection, it basically shields, it creates a shield around you in order to avoid or to prevent people from claiming anything that you have personally. So the number one reason why we form an entity is to protect our personal assets. With the LLC, it's also very easy to maintain. You don't need board of directors. You don't need board minutes or anything like that, although you should have them. You don't need bylaws. You do not need stockholder certificates. So it's very low maintenance, very low cost. In the state of Illinois, it's $150 to open an LLC. In states like Indiana, it's about $50. So very cheap, very low cost, very easy to start. It was formed mainly because people were having issues with corporations, where it was a little too complicated to run, just too much maintenance. So they formed this newer version of a corporation, which is the limited liability company. Gives you the same exact benefits as a corporation, but now you're just getting more, or you're getting additional sort of benefits or flexibility. One thing I like about LLCs, now all my companies are legally structured as LLCs, by the way. One thing I really like about LLCs is the flexibility to choose how you want to be taxed. So you get to be taxed as a sole proprietorship, which is what most people do, which could be a mistake, and I'll tell you why in a second. But taxed as a sole proprietorship, a partnership, which is 2 or more people, an S corporation, very favorable, so that's 1 or more people, or a C corporation, which you should never do, by the way. So an LLC gives you the flexibility to choose how you want to be taxed. This is very, very important. This is where the tax planning, our service, our number 1 service in Badu Tax Services is tax planning. That's the number 1 service that we offer currently. It's our breadwinner service because we help clients truly be able to maximize the tax benefits of their LLCs. So just to recap, LLCs give you personal liability protection. It's cheap and low maintenance, or it's low cost or cost effective and low maintenance. It also it gives you flexibility, and then last but not least, it gives you added stability. Now let's talk about the C corporation. C corporation is basically the same thing. Everything I just told you is the same thing. The difference is that a C corporation is high maintenance, so you have to have bylaws, stockholder certificates, board meetings, board of directors. I mean, there's so many things you have to have with a C corporation. And unlike an LLC, which an LLC is not a tax structure, it's simply a legal structure. But if you're an entity that elects to be taxed as a C corporation, you are subject to double taxation, meaning that if you were to make a profit, let's say you made a profit of $100,000, and you decided to take a distribution outside of your salary of $50,000, not only do you have to pay taxes, corporate taxes on the $100,000, you also have to pay capital gains or dividend taxes or dividend rate taxes on the $50,000 in distribution. So that's called double taxation. You tax both at the corporate level as well as the personal level. An LLC that's taxed as a sole proprietorship, partnership, or S corporation does not have to pay tax at the corporate level. You just pay taxes at your personal level. So you pay taxes when you file your 1040 or your personal income tax return. And that's what they call a pass-through or flow-through entity. So with the C Corp, you can see here that it can really cost you tax-wise if you're out there running a C corporation. C corporation are only for bigger companies such as Apple, Microsoft, because in order to go public, you have to become a C corporation. In order to issue an IPO, you have to become a C corporation. And the reason for that is just because C corporations gives you more legal protection. But the LLC gives you legal protection as well, and it gives you the tax benefits if you elect to be taxed as, let's say, an S corporation. Now, an S corp, although it's not a legal entity, an S corp is simply a C corporation or an LLC that elects to be taxed as an S corp. But if you're starting out a flat out, let's say a C corporation, and then you elect to be taxed as an S corp, essentially what happens is that you get the asset protection. It is high maintenance, and the good thing here, main benefit of an S corporation, you don't have to pay what's called FICA or self-employment taxes. Self-employment taxes in the U.S. are about 15%, 15.6% to be exact. So with that being said, I mean, who really wants to pay an extra 15.6%? So with an S corporation, you can avoid most of the self-employment tax by essentially giving yourself, so essentially you're not self-employed when you're an S corp owner or an S corp tax entity, and that you don't have to pay the self-employment tax. It's a little complicated, but basically what we usually do is if you made $100,000 in profit, we would do 25%, so $25,000 as a salary. That's subject to the FICA or the self-employment tax. And then the $75,000, whether you spend it, whether you keep it in the company, is not subject to any FICA tax. So you avoid 15%, or it really comes out to about 10% because we have to factor in the deductions and all that. So you avoid about 10% on $75,000, which is $7,500 in tax savings. So by electing to be taxed as an S corp, that can truly be powerful. This is a strategy we use often with our clients. Is once they hit a certain amount in net profit, and we always use net profit to make the determination. Usually, once somebody gets to about $40,000 in net profit, that's where we would introduce the S corporation for them. And we do charge a fee to give them that advice. We call our tax class. Also, with S corporations, as a tax entity, you can only have up to 100 owners. You cannot have foreign owners in an S corporation. So it does have some limitations. So the word S stands for small. So it's really meant for smaller businesses. It's really meant for just people who are running maybe not even just a small business, but just a smaller business than a C corporation. And I'll give you an example. Badu Tax Services LLC is an LLC legally, but it's taxed as an S corporation to get the self-employment tax. Now, since you guys also do sell real estate or buy and sell real estate for people, I'll give you the benefit of actual property. So real estate should always be owned in an LLC and not in a corporation because there's a thing called built-in capital tax. So anytime we own a property, anything that's passive income, we use LLCs for, and anything that's active income, we use S corporations for, or LLCs taxed as an S corporation. Now, why should you incorporate your company? Really simple, 3 reasons. It enhances your credibility. Anytime I see the words LLC, INC, CRP, I take the person more serious. I don't work with any contractor who doesn't have the words LLC, INC, or anything next to their name or next to their company's name. If they're just out doing business in their personal names, I don't take them serious at all. Even if they're my own family, my cousin, I only work with people that have LLCs, INCs, CRPs, and that's just me personally. It just adds that added credibility to your name because I know that you're taking your business serious at that point, or at least you've taken the right first step to really running your business. The second one is to protect your personal assets. That's actually the number one reason why we set up an entity. The third one is easier access to capital. So if you're looking to get a line of credit, a term loan, SBA loan, whatever it is you're looking to get, you need to have an LLC or an INC or CRP. That essentially these banks, they don't trust anybody that's doing business in their personal name. Even though it's easier to go after the person because now that all their personal assets are exposed without this LLC or INC. But I would say essentially these are the top reasons why. And then we already went through the benefits of an S corp. But in case you guys need to recap, an S corp avoids self-employment tax on any profit that's not in the form of a salary. So any net profit is not subject to the FICA or the self-employment or the Social Security tax, which is at about 15.6%. So let's just move on really quick. Remember, if you guys have any questions, please feel free to chime in now, or you can save your questions to the end. We just have a few more slides to go. I like to keep my presentation short. Just quick nuggets, something you can take home and really
quick
within the business. Yeah.
Really quick, Jeff. Can you explain why it's important to wait until the company has a net profit of $40,000 until they form an S corp?
Yeah, that's a great question. Basically, the reason why is because to run an S corp, it's going to cost you money. If you're doing your S corp through my firm, we charge about between $500 to $750 per return for S corps. So it's going to cost you additional filing fees. It's also going to cost you in payroll fees. For example, you have to run payroll as an S corp. Usually we do it at 25% of net profit. So usually we run that through ADP. We have a partnership with ADP where we can get nice discounts, incentives, things of that nature. So it's going to cost you in payroll fees between $100 to $500 or so. And it's just a little more complex to maintain. You have to have board meetings, and I mean, hey, we like to go to our board. I'm going to my board meeting this month in Jamaica. So it's an added incentive. Although for me, I always view negative things or like things that are more hassle viewed to more benefits. So if you're telling me I have to have a board meeting, I'm going to go to Jamaica. I'm going to Ghana, Philippines, wherever it is. I'm not having my board meeting here in Chicago. I'm having it somewhere that's pretty nice and exotic. So basically, the cost benefit analysis usually makes sense when a person hits 40,000. I mean, you can go a little lower if you want, but I would say 40,000 is a sweet spot. 40,000 net profit is a sweet spot where we like to tell our clients, hey, let's convert you to an S corp. Does that answer your question? All right, so we have a quick question here. What things should be taken into consideration when transitioning investment property from personally held to an LLC? Yeah, I would say that's a great question. Although this presentation is not for real estate investors, this is for realtors mainly. However, since it's real estate related, I would say some things to consider are, for one, I mean, by the way, it always makes sense, in my opinion, to transfer property out of your personal name to an LLC. I think it makes sense from a legal standpoint because you're adding extra protection. Now, my advice is you also protect it with a land trust. So all real estate should be owned by a land trust and protection of an LLC outside of that as well. Now, what are some things to consider? For one, there's costs. I mean, my attorney usually charges me $500 every time I do a quick claim deed from my personal name to my LLC. Me personally, I don't own any real estate properties in my personal name. So I'm like, when it comes to asset protection, I don't play any games when it comes to it. So for a quick claim deed, it's usually about $500, sometimes $1,000 or so. So it's going to cost you money. Also, there's a thing called the due on sale clause, where a lender might call your loan due. It's not very likely, but it is possible that a lender, in the history of mortgages, it might have happened maybe 10 times. I don't know the exact number, but ultimately, due on sale clause is highly unlikely. That just means that the bank will call your loan due if they see that you're transferring title. Now, when you're doing a quick claim deed, you're not necessarily transferring title. You're simply adding to the title. So you're still on the hook for the loan, no matter what. The bank is still going to come after you if you default on the loan. So that's why it's not really a big deal, but I would say anytime you buy a property in your personal name and it's business related or it's a rental property, just do a quick claim deed or do some sort of land trust because it's going to benefit you tremendously from a legal standpoint. All right, and we also have at the end, we'll have a Q&A, so if you have any questions at the end, we always leave 10 to 15 minutes at the end for Q&A. If we don't have any questions within 5 minutes, we usually just end the webinar there. Well, let's just move on to taxes, which is essentially why a lot of people came here today. Now, you formed your entity, and now it's like, okay, well, what's the next step? I formed my entity. The next step really you have to consider is taxes. Why in the world should you file taxes? Well, because you earn an income. In the U.S., if you earn over $400 in net profit or self-employed income, you have to file a tax return by law, or the IRS is going to send you a letter saying you owe them some money. I get it all the time. Every single year, I get clients that come to me. I'm behind 5 years. I'm behind 3 years. I got a letter from the IRS saying I owe. I don't know what to do. Just file your taxes. Just do it out on time. Don't even. The extensions are nice. I get it that you might need some extra time. You're busy closing sales. You're closing sales like crazy. But just take some time out of your day to contact your accountant or whoever you decide to work with and say, I'm looking to file my taxes. The key is to try to get it done early. Get your books and records up and get it done by December or get it done by January of the following year. But you do have to file a tax return, especially for the group of people that I'm talking to today, which are realtors. You must file an income tax return because you earn an income. Even if you don't think you need to file, just go ahead and file. In order to get a mortgage, most realtors that I know are looking to get into the real estate game as well. They're looking to buy properties. They're actually looking to invest in real estate. So just go ahead and file it. Even if you don't think you should file, just go ahead and do it because, if anything, it's going to establish a good track record with the IRS and with the lender as well. And as we all know, in order to buy a house nowadays, if we're using a traditional lender, we're getting an FHA loan that allows us to buy a 1 to 4 unit building with as little as 3.5% down payment that can be subsidized by the government, referring to the down payment, and you get a closing credit from the seller. So basically, you can buy this property with no money down. You'll need some tax returns. You need at least 2 years or so of tax returns. There are some banks that can do 1 year if you're self-employed, but hey, let's just do things the right way. File your taxes because you earn an income. Now, filing taxes doesn't necessarily mean you owe taxes. So that's where I come in. That's where I'll sit down with you, look at your deductions, and make sure you're writing off everything legally possible. So it helps you stay compliant with tax laws and regulations. The key is you file annually. So we always file a tax return by March 15th for S corporations, and then S corporations and partnerships file by March 15th, and then individuals and C corporations file by April 15th of every year. And then you do quarterly estimated tax payments. The way we do this, every quarter, ideally, we look at our profit or our net profit for the quarter, and we're simply taking that number and we're multiplying it between 20 to 25%, and we're sending that check off to the IRS. Now, if your profit is zero or negative, you don't have to send anything. Congratulations. But if you're making a profit throughout the year, you do have to make quarterly estimated tax payments. And real estate, as beautiful as realtors, I will have another webinar for real estate investors, but I think as a realtor, you must own real estate because you can depreciate the bare bones out of that real estate property and claim a lot of those tax write-offs. And since you're a real estate professional, you get qualified as a real estate professional, which allows you to treat your passive income as active income. So you can use your passive rental real estate losses. So most of my clients end up showing a loss on their real estate tax return because of depreciation. We accelerate the bare bones of the property. So since today's webinar is not about the property itself, it's about the realtor themselves or the real estate agent. We're not going to get in too deep into that. Last month we did do a webinar on the property itself. So feel free to reach out to me. I can send you the video that we did on the property itself. But essentially what you want to do is you're making sure you're paying your quarterly estimated tax payments on time. Usually about every 3 months. So the first quarterly tax payment is due April 15th. The second one is due July 15th. And then you go to September 15th and then January 15th. So just a few dates on that when it comes to quarterly estimated tax payments. And then filing a tax return can help you get a refund. So you can receive a refund when you file your taxes. Let's say you've been making quarterly estimated tax payments and you've been overpaying. Well, the refund is simply money you've overpaid to the government, and they're sending it right back to you unless you qualify for the Earned Income Tax Credit, the Child Tax Credit, or the American Opportunity Tax Credit, or the AOTC. So you can get a refund for those with kids or getting credits, things of that nature. You can get a refund for filing your taxes. It shouldn't be expected, but hey, if you're doing things the right way, you might get a small refund at the end of the year. Not necessarily a good thing, but at least you're doing things the right way. Assuming you're writing off things legally, all that good stuff. The IRS has hammered down tremendously on people who've been excessively legally writing off things on a tax return. So my advice here on this slide, do things the right way. Write off as much as you can legally. We'll talk about that on the next slide. But just do the right thing here. Trust me, you do not want to get in trouble with the IRS. A lot of my newer clients that come to me learn it the hard way. But you can write off most of the expenses as a business owner. And let's get into that really quick. This is like probably the most important slide on here. When it comes to taxes, as a business owner, we came to America we were born in America to live what's called the American dream. Part of the American dream was to own a business and to be an investor. Essentially, that's truly who benefits from the tax code: business owners and real estate investors. If you're both, hats off to you. You're doing great. But essentially, as a business, you get to treat your life as a business. So everything can become tax deductible that's related to your business. So you're allowed to write off certain expenses to reduce your tax liability. In order for a business expense to be tax deductible, it has to be ordinary and necessary. As a real estate agent or a realtor, it is absolutely ordinary to have MLS fees. It is absolutely ordinary to give gifts, champagne, and things of that nature to clients. It is absolutely ordinary for you to have a car. It's very ordinary. So ordinary just means it's in the ordinary nature of your business. Necessary means it's necessary to run your business. It is absolutely necessary to take out a client for lunch. It is absolutely necessary to go to Vegas. or Thailand or Jamaica, wherever it is, to have your board meetings. You can be getting clients in these countries as well. You can do business globally. I mean, Apple is out there doing board meetings in other places. You stay home and do your board meetings. And it's very necessary for you to own a nice car. You're showing off, or you're demonstrating to your clients that you're somebody who's savvy, who they can take serious. So necessary means it's necessary for you to grow your business. That's the way I like to put it. Examples include meals, travel, fees, dues. For a meal to be deductible, you have to be discussing business before, during, or after the meal. So you can be eating lunch with your spouse, eating lunch with your parents, whatever, a client. As long as you're discussing business, you can deduct that. For those with a spouse, I highly recommend that if you're a business owner, get your spouse involved in some type of business, including your own business. Because now every time you guys go out to eat, or even at the dinner table, let's say you made a meal at home, it becomes tax deductible. Travel, anytime you're traveling, that should be captured as a tax deduction. I mean, we're business owners, so anytime we travel, we're always doing business. The rule here is you have to work at least 4 hours in a work day. Travel days, you get a pass for travel days. You also get a pass for any holidays. And guess what? The best time to travel is during the holidays. So as long as you're working 4 hours during the work day, or you can declare a board meeting. You can have up to 4 board meetings per year usually. A board meeting simply means that you're sitting in a room for about 5 to 10 minutes or however long you need, whether it's with your spouse, your kids, whoever's on your board of directors. It could be just yourself. You're sitting in a room, you're putting something on a letterhead, and you're simply just typing, hey, this is how much profit we made this quarter. We acquired X amount of clients. These are some of the things we'll be doing next quarter. It's really, if anything, use this as a retreat, as a company retreat, for you to really recap how the went. In reality, you should be doing these things anyway. So why not go somewhere like Jamaica or Thailand or Ghana, Philippines. I mean, wherever it is you decide to go, you can have it at the board meetings. That's the rule. Either you use the 4-hour rule or you use the board meeting rule. Fees, MLS fees, listing fees, licenses, all that good stuff, dues, subscriptions, brokerage fees, all that good stuff are tax deductible. Retirement savings, business owners are in the best position to save for retirement. You can have SEP IRA, simple IRA. Won't get into the details of it, but basically you can save up to about $56,000 a year for retirement. That's not even including non-qualified plans such as life insurance, permanent life insurance policies, health savings accounts, annuities. So accounts like that, that's not even included in the $56,000. $56,000 doesn't even include the Roth IRA, which is highly recommended. But basically, you can write off retirement contributions as a business owner. And remember, business owners are in the best position to save for retirement. You can save more money than anybody else on this planet when it comes to taxes. Moving on, home office. As a realtor, I know you have a home office. A home office is simply a room in your home that you have maybe a desk, you have a chair in there, a computer. It cannot be used for any other purposes, such as sleeping or putting the baby in that room. So you can write off your home office, home studio, whatever it is. You can use the simplified or the regular method. Simplified method, you simply take $5 and multiply it by the square footage of the home office. The regular method, and that's best for people who own a home. So if you're a homeowner, please use the simplified method, because then you can also double dip and use your itemized deductions, your property taxes, mortgage interest on your Schedule A or itemized deduction, although most people aren't itemizing nowadays because of the new tax reform that was passed in 2017. You can also use the regular method. Regular method is where that's more for renters. So that's where you take your rent, your utilities, all those things, and then you multiply that final total number by the proportion of the square footage of your home office divided by the square footage of your total home. Health insurance premiums are fully tax deductible for business owners, so that's something to keep in mind. If you have health insurance, you should be deducting your premiums. 1/2 of the FICA. This is why, even though the FICA tax is 15.6%, in reality it's about 10% because of this 1/2 deduction. Now, 1/2 doesn't mean 1/2 of 15.6% effectively. It just comes out to about 10 to 11%. That's what the math. I've done the math quite a few times. It usually comes out about 10% effectively that you're paying. So this is why having a company that's taxed as a sole proprietorship, whether it's an LLC or just a standard sole proprietorship, after you hit the $40,000 in net income, it's going to cost you a lot of money. That's $4,000 extra out of pocket that you don't need. And consider becoming an S corp for tax purposes to get rid of the FICA tax, at least most of it. That slide, content related, is we talked about the entities. So you've gotten your LLC going or your S corp going. You got the tax game down pat. You've hired a tax professional. They're walking you through all of this. And now, what do you do throughout the year? You need to keep your books and records at all times. This is extremely critical right here. You have to make sure that you're keeping your books and records at all times. This is a very serious point because the IRS will get on you about not having books and records. By law, as a business owner, by business owner I mean a 1099 or somebody who's running a business that they actually own or a business that they started. You need to have books and records at all times. The IRS can come and audit you at any time. The first thing they'll ask you for is, where's your profit and loss? If you don't have one, well, you just failed to audit. Because, I mean, how can you operate as a business without a profit and loss? And then they ask for your receipts. Receipts are simply backup. You should always keep your receipts. Best practice, you simply snap a picture of the receipt on your phone, toss it in a folder somewhere, or attach it to your QuickBooks transaction. But to keep proper books and records, I highly recommend you get QuickBooks. QuickBooks allows you to automatically download and categorize transactions, participate in online billing, create professional invoices and estimates, upload receipts through your phone or through your computer, and create customized financial reports as well as tracking inventory. Now, as a real estate agent, we usually don't have inventory as like an actual on our books. We do sell inventory, or we do buy and sell real estate for people, but that's not our inventory. That's other people's inventory. The pros of QuickBooks, it's a full-blown accounting software. So it's all you need, really. It has a professional look and feel. You can send invoices. You can track payments. You can do a lot of things in QuickBooks. It's the best software in the industry, according to research, and it offers plenty of discounts, especially if you have somebody like myself who's a certified QuickBooks Pro advisor. And then it saves business owners a ton of time, about 10 hours a month on average. I mean, imagine what 10 hours a month can do for you and your business. Now, the con is really there's only one con. You do need some training, and we do offer QuickBooks trainings for all of our clients and prospects. So if you want to learn all the great things about QuickBooks, you do need at least 1 hour of training. Nothing too crazy, but in order to truly get the look and feel of everything, you do need to make sure you get some training. So just to read, QuickBooks is great to keep your books and records. You should be keeping them at least on a quarterly basis. By keeping them, I mean keeping them up to date every quarter at least. For me personally, I do it once a week. Every Friday, I block off 30 minutes of my calendar to get my QuickBooks reconciled for all of my companies. We have somebody who enters all the data and now with QuickBooks, it does provide automation, so it automatically links to your bank account, and you just have to click. We have somebody who does that 30 minutes that I spend every week, is simply to make sure they're doing it the right way. So with that being said, I mean, let's just get into some questions. This is my contact information. My email is jb@badutaxservices.com. You can also call me, 773-679-7198. You can find me on social media at Badu Tax Services, or our website is badutaxservices.com. So with that, we'll open it up the floor for any questions. We have about 15 or so minutes. For those who don't have any questions, you can feel free to log off, or if you just want to stick around. The presentation portion is officially done, but I would love to answer any questions. You can ask your question via the chat box, or you can just speak your question. So any questions? If we don't get any questions by within the next 3 minutes, we'll just call it a webinar. Definitely thank you guys for tuning in. It's always appreciated for you guys to come out and listen to some information. Hopefully you gain some value from it. This is recorded, so you will have access. This will be posted on my YouTube channel. We always post all our recordings on the YouTube channel. YouTube channel is simply Jeff Badu. We have a comment here that says, great info, Jeff. Thank you. I'll shoot you an email to get the link from the November session. Absolutely. And if you need to schedule a follow-up, please do so. I mean, get your follow-up session in. We do free 30-minute consultations, so at a minimum, you get free 30 minutes. We have some team members here that join us on the webinar today. But, yeah, and the best time to plan for taxes is right now, actually. I mean, we're getting close to the end of the year. I have some travel plans, so it won't necessarily be free the rest of the year, but we'll definitely be more than happy to help you guys truly build. And one thing to note, the average person in America pays 40% in income tax, in taxes, I just say taxes in general. And I can help you cut that by at least 90%. So just something to keep in mind. There's so many strategies out there that we can use, and this is truly, the tax code is very powerful. It was actually meant, it was created to help you, not necessarily to hurt you. So we got about 2 more minutes or so. If anybody doesn't ask any questions, we'll just call the webinar. And yeah, we'll just wait on a few questions to come in. We got just about 1 more minute before we close the webinar. It's perfectly fine not to have any questions. We did have some questions throughout the presentation, so that's good news. But yeah, I mean, if you guys ever need anything, don't ever hesitate to reach out. I share a lot of content on even my website, jeffbadu.com. There's tons and tons of stuff. I'm releasing 2 books next year. And yeah, hopefully you guys can be a part of everything that we have going on. So it doesn't seem like we'll have any questions, so we'll officially end the webinar at 7:49 p.m. Central Time. So let me go ahead and actually stop the recording.